Good afternoon. Happy Friday, January 14th. Mark Milam here, your mortgage professional with Highland Mortgage, coming to you with this week's interest rate summary and market update. Boy, the bloodbath that is 2022 continues. We certainly have seen this since the markets reopened back on January the 3rd, all the way now to January the 14th. Just a heavy sell-off in mortgage-backed securities, meaning interest rates are headed up. The 30-year fixed is headed up, now getting up into the mid 3% range. No one likes that. No one wants to hear that, but that's where we're headed. And this is all centered around the enormous amount of pressure that are on mortgage-backed securities. Mortgage-backed securities are just long-term bonds, and bonds hate inflation. And unless you've been under a rock, you've heard that word, inflation, many times over the past couple of weeks. We all know we've been dealing with price inflation for the past year. Everything from the pump to the grocery store is more expensive. Now we're dealing with wage inflation, right? We've got the Great Resignation, those 55 and up that have exited the workforce and maybe are not coming back because they've made so much money in the stock market or their house is worth so much more. They've got plenty of liquidity. We also know about the lower end of the spectrum, those folks who put their mortgages or their rent into forbearance or able to hang on to their savings. They're not quite ready to enter the workforce, at least not on a full-time basis, and all of that is driving up wages. All of that pressure is going against fixed return instruments like bonds. We also know that the Fed is tapering their mortgage-backed securities purchase program. They're doing it more aggressively than they thought they would. They're now planning on raising the Fed funds rate perhaps as early as March. That's sooner than expected. And they're not going to be reinvesting the proceeds from their $1 trillion balance sheet or over a $1 trillion balance sheet back into those mortgage bonds. That's some unanticipated news. It's just bad news everywhere for bonds. So let's take a quick look here at the 30-year fixed and see exactly what's happened since the year started. So I'm going to blow this up just a little bit. You can see it more clearly. So this is what's happened on the 30-year fixed since the year started. Right here is this increase in in the 30-year fixed. Let me zoom into a 1-year look back. So right here, starting around December 23rd, and we move on up through January the 13th. They haven't reported because it's not the close of business yet today. And you can see the precipitous rise here in the 30-year fixed. And we kind of have to go all the way back to maybe February of 2020, right at the beginning of the pandemic, to start to see a similar level for the 30-year fix. So really normalizing back to pre-pandemic levels. And you only have to go back maybe another year to see levels approaching 4%. So all told, not too bad in terms of where we are historically. It's just not where we were with those incredibly low 30-year fixed rates that we experienced in 2020 and 2021. Now, you've probably seen some headlines like this, the U.S. seeing the worst monthly inflation numbers in 40 years. That's absolutely true. Inflation now over 7%. That's easily eclipsing 300% of the Fed's target. And we haven't seen that in 40 years. I was 11 years old the last time inflation was this bad. So many of us don't recall, at least not as adults, we don't recall inflation at this level. And really, what does that mean? What does that mean where we're headed? Well, what that means is you're going to start to see the Fed take a lot of aggressive action to try to get inflation under control, and that's going to slow down borrowing. And there's already some evidence, a little bit of light at the end of the tunnel, that perhaps we're in the worst of it right now, and there's better news to come here in short order. Let me show you what I'm talking about. This is an article I found on ABC where the Russell Price, the chief economist for Ameriprise, was interviewed, and he said he expects inflation to peak at 7.1% in December and January. Well, here we are, it's January, and guess where inflation is? Right at 7.1%. After that, he expects inflation to fall towards 4% by the summer, below 3% by the end of the year, and stay above 2% through 2023. So with the Fed's target at 2%, the hunch is, the prevailing sentiment is that perhaps by this time next year, no one's really talking about inflation all that much. We had a lot of transitional, transitory, ephemeral items that we were faced with as we moved into the pandemic. As we exit from the pandemic and it becomes more of an endemic, we're going to see the exact same thing. So this is part and parcel of getting the economy back normalized, and we're going to have this inflation hanging on for perhaps a few more months, but then normalizing, and that should be good for interest rates all around. I hope you have a great holiday weekend. If I can be of any service to you, don't hesitate to reach out, mark.milam@highlandmtg.com. Thanks.